Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about CarMax Inc. quarterly report. CarMax Inc. offers a variety of businesses and services including retailing used vehicle auctions, extended protection plans for customers, reconditioning and vehicle repair services, financing alternatives for retail customers through CarMax auto finance arrangements with various financial institutions. The primary drivers of revenue growth or decline are largely influenced by fluctuations in used vehicle sales, wholesale vehicle sales, and extended protection plan (EPP) revenues. Revenue decline is primarily attributed to a decrease in used unit sales, average retail selling price, and wholesale vehicle unit sales. Additionally, steep market depreciation, decline in EPP revenues, and interest margin compression due to increases in interest rates and competitive pressures have also contributed to revenue decline. On the other hand, there are no reported instances of revenue growth. However, factors such as marketing spend on a per total unit basis is expected to increase year-over-year in the fourth quarter, driven by investment in acquisitions, may potentially contribute to future revenue growth. Net income and profit margins decline. A summary, the financial summary, reveals a decline in net income and profit margins for the company. In Q3 2025, net income decreased by $62.2 million compared to Q3 2024, with no corresponding increase in revenue. This trend continued throughout the year, with YTD 2025 net income decreasing by 10.4% and net income margin declining from 10.4% to 9.3%. The decline in profit margins can be attributed to several factors. A decrease in EPP revenues due to lower retail unit sales contributed significantly to the decline. Additionally, changes in originations by one tier of credit providers affected other tiers, further exacerbating the issue. Furthermore, the company plans to implement lower used vehicle margins in Q4 2026, which will likely put pressure on profit margins in the near term. The increasing marketing expenses also pose a challenge for the company's profitability. Overall, these factors have led to a decline in net income and profit margins, indicating a need for the company to reassess its strategies and make adjustments to improve its financial performance. The company is generating a significant amount of positive operating cash flow, with net cash provided by operating activities totaling $2.34 billion in the first 9 months of fiscal 2026. This represents a substantial increase from the previous year's figure of $478 million and $2.34 billion in 2025, indicating a notable improvement in the company's ability to generate cash from its core operations. The company's debt level and interest expenses have undergone significant changes over the past few years. Initially, the total debt decreased from $21,161,218 to $19,497,821, page 5. However, this trend was reversed on page 62, where it increased to $18,707,207. Long-term debt also saw a decrease from $1,570,296 to $1,169,768, page 5, while non-recourse notes payable decreased from $16,567,044 to $15,417,006, page 5. Despite fluctuations in total debt, interest expenses have consistently decreased. On page 20, interest expense dropped from $193,200,000 to $188,300,000. Furthermore, on page 56, interest expense decreased by $4.9 million and $15.8 million for the periods ended November 30, 2025 compared to 2024. Overall, while debt levels have been volatile, interest expenses have shown a downward trend over time. Management is emphasizing a strategic shift towards core business growth, investing in digital capabilities and store expansion to enhance customer experience. To achieve this, they plan to operate leaner, improve decision-making speed, and reduce margins for competitiveness. Key initiatives include nationwide rollout of new products by Cone F. IT27 $150 million in exit rate savings from SG, and expense by end of F. IT27 slightly increased marketing, spend in fiscal 2026 expansion into profitable Tier 1 originations, and testing expanded lending in Tier 2 space. The company is also investing in growth capacity initiatives. new store openings, and capital expenditures totaling $575 million in fiscal 2026. Management will prioritize meeting warehouse facility requirements and monitor changes in the competitive landscape and economic conditions to ensure successful execution of their funding program. The company has made several significant transactions involving acquisitions and divestitures. In terms of acquisitions, there is no clear indication of any major purchases or mergers. However, it appears that the company has acquired a gain from the sale of auto loans in the third quarter of fiscal 2026. On the other hand, the company has engaged in several divestiture activities. Notably, it sold approximately $930 million worth of auto loans through a non-prime securitization transaction on September 24, 2025. Additionally, the company transferred auto loans to held for sale and subsequently released $42.2 million from an allowance recorded for loans that were previously classified as held for sale and subsequently sold. The company's financial summary reveals that it has been actively involved in buying back shares. Specifically, between September and November 2025, the company repurchased approximately 10 million shares. This is part of a larger share repurchase program, which was authorized by the board with $2 billion allocated for this purpose. Concerns surrounding inventory buildup and supply chain disruption, the financial summary highlights two pressing concerns for the company's performance. Firstly, there are indications of an inventory buildup due to decreased demand in used vehicle sales and wholesale vehicle gross profit decline. This is further exacerbated by a potential reduction in available inventory sources. Furthermore, supply chain disruptions are also looming large. The reserve for estimated returns and contract cancellations suggests that there may be issues with the timely delivery of goods. Additionally, concerns about failing to liquidate inventory expeditiously hint at potential bottlenecks in the supply chain. These two interconnected issues pose significant challenges to the company's operations and profitability. Addressing these concerns is crucial to mitigate their impact on the business. That concludes the financial summary for CarMax, Inc. Feel free to comment below, and I will be happy to answer them when possible.